Century momentum is one of the weirdest strategies we have added to BestFolio. It is a two-asset switch, but the history goes almost 100 years. When the momentum sleeve is healthy, it owns the strongest US momentum stocks. When that sleeve falls below trend, it moves to 10-year Treasuries. That simple rule produced about 16.3% annual growth from 1927 through 2026. The uncomfortable part is that the backtest is brilliant, but you have to understand exactly what is real and what is reconstructed. The rule is intentionally simple. At each month end, look at the momentum sleeve and calculate its 10-month moving average. If the sleeve closes above that average, the strategy holds momentum. Today, that means the SPMO Momentum Fund. Before SPMO existed, the history is stitched through MTUM and then the public Fama French top decile momentum portfolio. If the sleeve closes below its 10-month average, the strategy goes defensive and holds 10-year Treasuries, represented by IEF in the live version. One monthly check, one holding, no discretionary override. The headline numbers are strong enough to look almost suspicious. Over the validated century scale window, century momentum shows roughly 16.3% compound annual growth, a 0.74 Sharpe ratio, and a maximum drawdown around minus 46.6%. It switched regimes about 1.4 times per year. The important comparison is this: applying the same trend filter to the broad S&P 500 does not create the same result. The return engine is the momentum factor. The 10-month filter is the break. There are two separate ideas working together. First, cross-sectional momentum. Stocks that have outperformed recently tend to keep outperforming for a while. That effect has been documented for decades, and the Fama French data lets us study it far before modern exchange-traded funds existed. Second, absolute trend following. The 10-month average is not trying to predict recessions. It is just asking whether the momentum sleeve is still in an uptrend. When the answer is yes, the strategy presses the factor. When the answer is no, it stops compounding equity drawdowns. Here is the honest caveat. The pre-2013 history is not a tradable SPMO fund. It is an academic, top decile momentum portfolio. That portfolio has heavy internal turnover, no realistic fund expenses, and no trading cost drag. SPMO tracks the character of the factor, not the exact academic decile. So I would not treat the century backtest as a promise that an investor can capture every point of historical return. I would treat it as evidence that the structure has been unusually persistent. Own the momentum winners while they are above trend, and step aside when they are not. Century momentum is not a sleep-at-night conservative model. A minus 46% historical drawdown is still a real punch. This is an aggressive satellite for investors who already believe in factor momentum and want a very long stress test behind the rule. The appeal is not low drawdown. The appeal is that the strategy combines a very high return engine with a mechanical risk-off switch. It belongs next to other strategies, not as the only thing in a portfolio. BestFolio now tracks century momentum with the same live signal framework as the rest of the strategy library. You can see the current regime, the current holding, the moving average test, the full back test, and the caveats in one place. If you want to follow it, the link is in the description. And if you want more research like this, subscribe. I break down strategies with real data, clear rules, and the trade-offs left in.